Okay, so Wall Street's on inflation watch this morning. The release of the Producer Price Index, the PPI, and retail sales are coming out today. Let's bring in right now Stephen Rasciuto. He's chief economist at Mizuho Securities, and Ian King, senior analyst at Banyan Hill. Guys, good morning.
Good morning.
Good morning.
Stephen, I first want to talk about, yesterday we got CPI, and it was kind of a mute number. I mean, if you look at the numbers here, 0.2% month over month from January to February, 2.2% year over year. Consider what the economy's doing. That's a pretty tepid number.
No, you're 100% correct, and it's probably going to show through in terms of the PPI, again, number this morning. I think what we're really looking at in here is the reality that a falling dollar is not having as much of an impact as we had thought it could have on the inflation environment. But I think that's only because the dollar kind of stabilized towards the end of last year and has been pretty much in a flat trading range since then. I think if we continue the move down, you'll start to see more upward pressure on inflation as the year progresses.
Ian, we're looking, of course, at what are these market-moving data numbers, but there's a really interesting piece this morning out in the Journal about Bitcoin. And the Bitcoin has now become the new barometer for investor sentiment. Bitcoin cut in half, 20 to 10,000 a month before the global stock sell-off that we saw earlier this year. Are you hearing the same thing?
Sure. Well, lately, Bitcoin investors look like that clip of Elsa trying to push a truck out of the snow in the middle of a blizzard. But in reality, in these late cycle moves, we see a rise in some type of speculative asset, whether it was .com stocks in the late 90s or even junk bonds in the late 80s and more recently the housing market in the mid 2000s. So you can look at Bitcoin and the rest of the crypto asset market as a speculative asset that moves in the end of late market cycles.
Stephen, what do you make of that point and kind of this new trend in thinking for investors?
Well, I think what you have to keep in mind is the reason why there is interest in something like a cryptocurrency is because central banks have generally been debasing their currencies for years. And it started back in the 1990s with BOJ and has continued through the crisis period with the Federal Reserve and now the ECB, where central banks have ballooned their balance sheets, basically financed the budget deficits for these regions, all through printing money. And that has debased the value of the currency. The only good thing is on a relative basis, they've all been doing it, so not one currency has been weaker than the other. And for a while, the U.S. dollar was benefiting from that because we were at the leading edge of what was happening in terms of the rebound in the economy.
Right.
Now that's kind of moved off to the second stage, where Europe and Asia are doing a bit better.
And all of this is what the Fed's going to have to look at. And again, this inflation data, it may accelerate or decelerate interest rate hikes. I want to bring up something else today with you, Ian. Really important anniversary. Today is the 10-year anniversary of the collapse of Bear Stearns, that marriage, if you will, that shotgun marriage that was. This is the beginning of the financial crisis. We were over-leveraged. Banks took on too much risk, especially Bear Stearns. Do you worry that 10 years later we're in that same environment? And I say this because there is a lot of hot momentum, and some say that the market is overheated. Are we in that moment again, do you think, Ian, that we were in 10 years ago on a lesser scale?
There are definitely pockets of that, but I don't think there's as much wide ownership of speculative assets as there were in 2007, 2008. The banks obviously have deleveraged. They're under different types of regulations right now. So I don't see the same type signs of optimism and exuberance as we had in the end of the last cycle.
Those of us that covered as, well, journalists, that'd be me, is the dot-com bubble and then, of course, the financial crisis. You always worry when you start to see those numbers, especially in the markets, go up and up and up. But we shall see. It's 10 years, $85 billion company gone. Guys, thank you very much. We appreciate it. Stephen and Ian.
Thank you for having me.
$400 billion company. They were worth $400 billion 10 years ago. Gone.
Gone.
Amazing. Yeah.
Coming up.